Good afternoon. You're watching Businessworld Live. I'm Jes Delos Santos. Let's take a look at how the trading day ended. And as you can see here in my chart, at the moment, you'd see the index snapping its three-day gain, sinking below 7,300. Yet again, it is down 0.6% to 7,258.11, sinking further from that 7,400 level. Of course, much optimism at the start of the trading week that local shares would at least reach that level. It has been in the red throughout the day. Foreign investors, in fact, also turned net sellers after going on buying mode for the past 2 days. Net sales are at 25 million pesos. Also, something that came in right after trading close here, you have, of course, a number of our economic managers speaking in separate forum about how, of course, the economy has been faring so far. For one, you have Finance Secretary Carlos Dominguez saying that the government can keep its bias for domestic financing and that it is open to further tap the central bank for loans should it be necessary. He's saying basically that the large structural liquidity of our financial system will actually enable us to continue prioritizing domestic financing. That is to somehow mitigate or scale down the buildup of foreign exchange risks. He said that during a forum organized by the Management Association of the Philippines. The central bank's reduction of banks' reserve requirement ratio or triple R in the past 2 years helped shore up cash in the system. That's according still to Dominguez. Um, Likewise, speaking at a forum over at Reuters, you have Central Bank Governor Ben Jokno saying that the current monetary policy is sufficient and that there's room for higher fiscal spending. He's saying as well, in terms of growth, the worst is already behind us and that a remarkable rebound should be expected within the year. He also mentioned a number of green shoots here, such as improvements in the country's remittances as well as foreign direct investments. Let's see how these statements, both from Dominguez and Jokno, will of course color trading for the rest of the week. But moving on from there, if you try to take a look at again the index, it's been a red day all throughout. Also looking at the sectors as well here, you'd see financials losing the most here. They are down 1.6%. Services not far behind, also in the red, ending the day lower at over 8%. Industrials, property, and holding firms, all, of course, in the red as well. Looking at the specific stocks here as well, in terms of our leaders and laggards for the day, only a number of stocks here which are actually in the green, the likes of SM as well as ICTSI and even Emperador, but majority again of the stocks ending the day in the red. Something that we have to keep an eye on, of course, would have to be Metro Bank, today's worst performer. They are down by as much as 5% today. It has managed in a way to gain more than 12% the past 3 days, but again, it is down by as much as 5%. Now priced in at 47 pesos and 50 centavos a piece. So is the rest of the financial counter, with only BDO and China Bank proving to be resilient. That, of course, after bad loans rose for the 10th straight month in November, that as pandemic actually hurt borrowers' capacity to pay. Likewise, also you can see here in this chart, FGen also one of our biggest losers for the day here, down by as much as 3.6% to 32 pesos and 40 centavos, snapping that 4 day rally for the shares, even rising as much as 8% yesterday. That's after, of course, some investors deemed the stock to be undervalued given its exposure to renewable and clean energy. A number of investors as well saying, they might actually benefit from the spillover from the rise in AC energy, but that overflow, as you can see at the moment, might have actually ended today after FGen again ending the day down by as much as 3.6%. Now, moving on to one other stock, that is Megawide, ending Tuesday in the green, bucking today's sell-off. Megawide share price now at 8 pesos and 64 centavos, up 1.7%. The construction firm enjoying really a 3 day rally in the back of a joint venture deal with Cebu City for the redevelopment of the Cebu Carbon Market. Megawide's total investment for the project is estimated at 5.5 billion pesos. It has a 50-year term agreement extendable for another 25 years. Now, over in Metro Manila, the company is still waiting for government's decision on its NAIA rehabilitation bid. Megawide saw its 9-month total revenues down 30% to 9 billion pesos from effects of the pandemic. Also, of course, the one thing we have to be taking a look at would have to be Bitcoin. That's after, of course, on a Monday, it did tumble by as much as 20%, bringing it back down to March 2020 levels. But looking at how it has been performing so far, as you can see earlier, before broadcast, it was up by as much as 6%. As you can see here now, somehow rising even as much as 7%. It's now back at the 35,000 level. Again, Bitcoin somehow managing to stage a comeback, a bit of a recovery after the 20% tumble that it saw on Monday. Now here are other headlines we're keeping our eyes on. Loan availments from the Bangko Central's rediscount window plunged in 2020. This is after banks tapped the facility for just 4 months, leaving more untapped liquidity in the market amid the pandemic. Rediscount loans fell 77% to 27 billion pesos as of end 2020. No availments were made for the month of December, with banks tapping the facility only in March, April, August, and September. Central Bank Chief Ben Jokno earlier mentioned that the policy adjustments infused about 2 trillion pesos of liquidity into the financial system. Union Bank Chief Economist Carlos Asuncion said rediscount loans could rise once the central bank starts hiking rates again. He says this is likely to take place by the end of the year or early 2022. And Fitch Ratings is warning that a delay in the rollout of COVID-19 vaccines may hurt the country's growth prospects. Fitch said a delay will pose downside risks, while an effective vaccine distribution could result in faster than expected recovery. Recall that Fitch has affirmed the Philippines' rating at BBB, with stable outlook on the back of modest government levels and still strong growth forecast amid the pandemic. Fitch sees the economy to have slumped by 8.5% for full year 2020 due to an improvement in activity indicators in the fourth quarter. The government expects the economy to shrink by 8.5 to 9.5% in 2020. The GDP fell 16.9% in the second quarter, and it again contracted by 11.5% in the third quarter last year. And to talk more about that, we have on the show Sagarika Chandra, Associate Director for Asia Pacific Sovereigns Team at Fitch Ratings. Good afternoon, Sagarika. Great that you could join us this afternoon.
Good afternoon.
Okay, so taking off from that report, as well as earlier in the day, you have Dominguez in a forum saying, Fitch's maintained ratings for the country shows that credit and the country remains to be credit and investment worthy throughout the crisis. But there's a different school of thought as well, calling for more spending, as they say that the government is allegedly obsessed with credit worthiness. Is the country being overly prudent? Is this the right track?
Thanks for your question, and nice to be here. Well, in terms of the way we have evaluated the Philippines and the government's response to the pandemic on the fiscal side, we think the measures that they have taken in terms of the support through the fiscal front so far has helped to some degree in the recovery, but just in terms of what it means for the fiscal deficit and the government debt to GDP ratio and the medium-term debt trajectory for the Philippines, we still see that the debt to GDP level will continue to rise, although it will tend to stabilize at our estimates of somewhere around 55% of GDP over the medium term. And even at the 55% GDP debt levels, the debt to GDP ratio of the Philippines, it still continues to be a bit, it's actually better than how peers are performing in the same rating category. So just in terms of the way the authorities have reacted on the fiscal front, we think the widening in the deficit and the increase in debt levels, it still puts Philippines in a more comfortable position when we compare it to other BBB rated sovereigns.
Okay, just to clarify, Sagarika, at the same time, if you can just move your mic closer to your mouth so that we can at least hear you better. Does this mean that the Philippines still has some room, leeway, to actually be on the side of borrowing more, at least spending more?
So from our perspective, they have quite a significant amount of room getting into the crisis. If we looked at Philippines' debt to GDP ratio in 2019, they were at 34% of GDP, and now we are expecting a pretty sharp increase in 2020, and then debt to GDP going up further to, as I said earlier, about
Mm-hmm.
55% by 2022. So we think that a lot of that room has been used up, and so going forward, there is quite very little room on the fiscal front for the Philippines to go in for a lot of extra fiscal spending.
Mhm. At the same time, earlier in the day, you have Central Bank Governor Ben Jokno alluding to, how there are already some green shoots here, specifically improvements in remittances and FDI. Do you think progress is, and he's at the same time saying that, rebound is already on its way, we are on track for recovery. Would you say there's a possibility of an upgrade? What measures should be taken to warrant an upgrade? And on the flip side, what could actually lead to a negative rating action?
So, for an upgrade, there are two key metrics that we'll be watching going forward from here onwards. One would be how Philippines' public finances perform, because if we look at the impact of the pandemic, a large part of that has, of course, the economy has been affected, but we're seeing a lot of impact on the fiscals. So, going forward, we'll be looking at a sustained broadening of the government's revenue base that enhances the
Mhm.
fiscal public finances, puts government debt to GDP on a firm downward trajectory. That could lead to a positive rating action. And also, Philippines continues to, score weaker than its peers on structural indicators. For example, governance indicators that we look at, which is from the World Bank. Those are again things that. If there's an improvement on those, then that again could be a factor towards a positive rating action. And on the negative side, again, it's the macroeconomy, the performance of that would be important. So if we see a slippage in terms of the macro policy framework, which hurts Philippines' medium-term growth potential or the recovery from the pandemic, I think that could again be a trigger for a negative rating action. And again, on the public finances, as I said earlier, if we find that the public finances, continue to rise at a more faster pace than we're currently expecting and remain on that upward trend, then that could again be a negative rating trigger. Again, just want to mention the externals, which has been a credit strength for the Philippines. And we've seen that, we're also expecting a small current account surplus in 2021 before it reverts to a deficit. The FX reserves position of Philippines remains quite strong. So
Mhm.
we see a deterioration on the externals, which could show up in widening sustained current account deficits or decline in foreign currency reserves, which is quite significant. Then those are again negative triggers for the rating.
And at the same time, you did mention in your report as well that the country's growth, at least in 2021, hinges largely on the country's vaccine procurement and distribution. Given the current scenario, do you think that we are on the right track?
So our growth projections, they don't factor in absolutely, the 6.9% that we're expecting for 2021 factors in some degree of progress on vaccine rollout. But this is a moving target, and the current information that we have is that a vaccine rollout is likely by May 2021. So there's still some uncertainty on that front. Our growth projections are taking a slightly more conservative view. So we're expecting only a gradual pickup in growth in 2021 and then a recovery in 2022. So while a delay or a lack of effective implementation of the vaccine could pose some downside risks to our growth forecast, it's not entirely baked into our current growth projections.
Okay, but nonetheless, it could still pose some risk moving forward if that in a way gets delayed. Thank you very much for your time this afternoon. Sagarika Chandra, Associate Director for Asia Pacific Sovereign Teams over at Fitch Ratings. Thank you.
Thank you.
And those are the biggest news this trading day, January 12, 2021. Join us again tomorrow at 9:30 a.m. for the market open and 3:15 p.m. for the market close. I'm Jes Delos Santos. We are One News.